Google Morning Traders, S&P 500 has just pulled back from an all-time record high, down 29 points, or 0.41%, and headlines are fixated on one word, Middle East. But here's what they're not telling you. This is the healthiest pullback this market has seen in 6 weeks. Let me cut to the number that matters most right now, 7,175. That's the level that has anchored this entire rally since late March, and as I speak, we are sitting just 25 points above it. If it holds, we are looking at a launchpad to 7,300 and beyond. If it breaks, well, that's a conversation for another time. Stay with me, because by the end of this video, you'll have 3 precise trade setups, conservative, standard, and aggressive, complete with specific entry points, stop losses, and targets you can execute immediately. No fluff, no jargon, just actionable levels. Here's my take. The S&P 500 remains in a structural bull market, but it has entered a tactical pullback within a rising channel. This is not a reversal. This is not a crash. It's simply profit-taking at record highs, amplified by geopolitical headline risk. The multi-time frame picture tells a clear, coherent story. Monthly chart. Overbought, yes, MACD at 522 and RSI at 70.3, but trending strongly with an ADX of 31.6, a clear sign of sustained momentum. Weekly chart, a textbook bullish flag formation. With all 4 key moving averages sloping upward, an unmistakable trend-following signal. Daily chart, digestion after a historic April rally that added roughly 9% in a single month, normal consolidation after a massive move. 60-minute chart, a controlled, orderly decline with shrinking volume, the exact behavior you want to see in a healthy bull market. Pullback. My line in the sand is 7,175. It's the confluence of the 60-minute swing low, the daily 20-period MA, and the lower boundary of the 2-week rising channel. Above 7,175, the path of least resistance is higher. Below 7,175, we shift to neutral and reassess. It's that straightforward. Before come to technical analysis, please remember to subscribe my channel, pull up your 60-minute chart and look at what happened overnight. The session opened at 7,228, made a run at 7,244, just 14 points shy of the all-time high, then rolled over. But here's the key detail. The sell-off was orderly. Volume on the decline hit 19,746 contracts, below the session average. If this were a distribution event, big money selling off, you'd see expanding volume on red candles. Instead, we are seeing contracting volume, which tells me the smart money isn't panic selling. They're waiting. Now look at the 60-minute moving averages. MA5 at 7,200, MA10 at 7,216, MA20 at 7,216, MA40 at 7,178. Notice the compression. MA5, MA10, and MA20 are all converging between 7,200 and 7,216, with the MA40 at 7,178 acting as a floor. When short-term moving averages compress like this, it's a coiled spring. The eventual breakout, when it comes, will be sharp, and its direction depends entirely on whether 7,175 holds. Shift to there. Daily chart, MA5 at 7,207, MA10 at 7,206, MA20 at 7,178. 3 moving averages clustered within 30 points, an extraordinary level of compression. The MA40 sits at 7,137, well below, serving as the ultimate backstop. The price structure is undeniably bullish. Higher highs and higher lows since the March 28 washout near 6,750. We've rallied roughly 480 points in 5 weeks, a massive move, and a 29-point pullback is statistically insignificant, less than a 0.4 standard deviation retracement on the 20-day range. The weekly chart is where conviction solidifies. MA5 at 7,107, MA10 at 6,836, MA20 at 6,873, MA40 at 6,765. All 4 moving averages are rising in perfect alignment, the textbook definition of a green light for trend followers. Every dip to the weekly MA20 since October 2025 has been aggressively bought. The last time we tested the weekly MA5, the early April pullback, the market bounced 200 points in 8 sessions. The monthly chart gives us the big picture context. We are at 7,200, with the MA5 at 6,921, MA10 at 6,828, MA20 at 6,376, and MA40 at 5,578. The index is trading well above all 4 monthly moving averages. This is not a market on the verge of a collapse. But the monthly RSI at 70.3 and MACD at 522 do flash a warning. We are overbought on the longest time frame. That doesn't mean sell, it means the pace of gains will likely slow, and pullbacks within the trend should be expected, and embraced, as entry opportunities. Now for the MACD across timeframes, on the 60-minute. The MACD histogram is negative but flattening. Momentum is decelerating, not reversing. On the daily, the MACD is positive but the histogram bars are shrinking, signaling the rally's momentum is pausing, not dying. On the weekly, the MACD is firmly positive with expanding histogram bars. The primary trend is intact. The theme here is clear: short-term consolidation within a medium-term and long-term bull trend. My specific levels to watch: immediate support 7,175, 60-minute MA40, daily MA20, and last week's structural swing low. Next support zone 7,140 to 7,145, daily MA40, and the top of the early May breakout area. Resistance 7,244, today's session high and the final barrier before the all-time high. Next resistance targets 7,286, measured move from the April triangle breakout, and 7,300. Psychological key level. Let's talk about why the market is moving today. Because the headlines are misleading. First, the trigger: renewed US-Iran tensions. The S&P 500 fell 0.41% as investors monitored developments in the Middle East, with the Dow dropping over 550 points, 1.13%. Oil prices spiked on the news, and that's the transmission mechanism. Higher energy costs threaten the disinflation narrative that has underpinned this rally. But here's what separates informed traders from headline readers. The sell-off was concentrated in the Dow, old economy, cyclical, energy-sensitive names. The Nasdaq dropped just 0.19%, with tech holding firm. Memory chip stocks like Western Digital, SanDisk, and Micron even rose 2.5% to over 6%. This is not a broad risk-off event. It's a targeted rotation out of energy-vulnerable sectors and into the AI and semiconductor names driving the earnings story, and that earnings story is extraordinary. S&P 500 companies are on track to report Q1 2026 earnings growth of 27.1%, the highest rate in more than 4 years, according to FactSet. Around 80% of S&P 500 companies have beaten earnings expectations so far, with profits up roughly 31% year-on-year. Full year 2026 earnings expectations have been revised up by 3%, and next 12-month estimates are up 4% just in the past month. This is fundamental growth, not multiple expansion driven by excess liquidity. The S&P 500 currently trades at 20.9 times forward earnings, a premium to the 5-year average of 19.9, but not extreme. The Shiller Cape has pushed past 37, which is historically elevated and warrants caution, but earnings momentum is accelerating, not slowing. Now the Fed picture, and this is critical. The Fed held rates steady at 3.5% to 3.75% at its latest meeting, retaining language that the next move was expected to be a cut. But internal dynamics are shifting. Neil Kashkari and Lori Logan both dissented hawkishly, signaling the next rate change could be either a cut or a hike, depending on economic developments. Prediction markets now put a 43% chance of a Fed rate hike before July 2027, and JP Morgan economists expect policymakers to hold rates steady through 2026 before pivoting to hikes in Q3 2027. This is the tension that will define the next 6 months. Extraordinary earnings growth versus a Fed that may be forced to tighten if inflation proves sticky. For now, the market is betting on earnings, but the seeds of volatility are being planted. On fund flows, the data tells a nuanced story. The SPY ETF saw monthly inflows of nearly $18 billion, with $3.2 billion on May 1 alone, signaling core equity exposure remains firm. 5-day net inflows into SPY total $8 billion. Reference, 13. But there's a countercurrent. Market chameleon data shows an institutional sell imbalance of minus $108.7 million, with large volume bursts totaling $10.3 billion in transactions. This is smart money trimming into strength, not panic selling, but rebalancing. The Fear and Greed Index sits at 66, squarely in greed territory. It hit 70 last week but hasn't reached extreme greed. This is not euphoria, but it's not fear either. It's the sentiment profile of a market that has climbed the wall of worry and is now looking for the next catalyst. Now let's talk correlation, where the Alpha Market Meridian framework adds unique insight. Bitcoin is your risk appetite barometer for the S&P 500. When BTC leads to the upside, it signals genuine risk on flow. When the S&P rallies but BTC lags, it's a defensive equity rotation. Watch this pair closely. Gold tells the geopolitical story. If gold breaks above its recent highs while the S&P 500 breaks down, that's your confirmation this pullback is more than profit-taking. Oil is the transmission mechanism for Middle East risk. Higher crude squeezes corporate margins and consumer spending, which feeds directly into S&P 500 earnings estimates. My 1 to 2 week outlook. The S&P 500 consolidates between 7,175 and 7,250 before breaking higher towards 7,300, driven by the tail end of a historic earnings season. The key risk to this view: a significant escalation in the Middle East that pushes oil above $85, triggering broader de-risking. Also on the radar, Nvidia earnings on May 20th. The single most important catalyst remaining this season. BY talking about trading opportunities. Please subscribe my channel. Let's get to what you're here for. Executable trade setups. 3 strategies. 3 risk profiles. Pick the one that fits your playbook. Strategy 1. Conservative. The pullback to support bounce. This is for traders who prioritize high probability, moderate reward, and capital preservation above all else. Entry condition. Wait for a 60-minute candle to close above 7,200 after testing, not breaking, the 7,175 to 7,180 support zone. This is your confirmation candle. Do not enter before this print. Look for a bullish engulfing or pin bar with a long lower wick that rejects the 7,175 area stop loss. Place your stop at 7,168, 7 points below the 7,175 support. This is structural invalidation. If 7,175 breaks, the entire 2-week uptrend channel is compromised, and you don't want to be long. This gives you a 32-point risk. Target 1, 7,230, prior session close and initial resistance. A 30-point gain, with a risk-reward ratio of just under 1 to 1. Target 2, 7,244, today's pre-market high and final barrier before the all-time high. A 44-point gain, roughly 1.4:1 risk-reward. Once target 1 is hit, move your stop to break even. This is non-negotiable in the conservative playbook. Protect your capital first, profit second. Invalidation. If the S&P 500 closes any 60-minute candle below 7,175, the setup is void. Exit immediately if you're already in. No hope. No averaging down. Respect the levels. Strategy 2, standard, the moving average compression breakout. This is the higher conviction play for traders willing to hold through intraday noise. Entry condition. The 60-minute MA5, MA10, and MA20 are converging between 7,200 and 7,216. This compression will resolve. Enter long when a 60-minute candle closes above 7,216. The MA10, MA20 zone, with expanding volume. Volume confirmation is essential. Low volume breakouts are traps. Stop loss, 7,190, 10 points below the 7,200 psychological level and the MA5. Logic. A false breakout above MA compression that retreats below 7,200 means sellers control the short-term tape. Don't fight it. Risk, 26 points. Target 1. 7,244, today's session high. 28 points from entry, slightly better than 1:1 risk-reward. Target 2, 7,286, measured move from the April triangle breakout and daily upper boundary. 70 points from entry, roughly 2.7:1 risk-reward, scale out 1/3 of. Your position at target 1, move your stop to break even, and let the remaining 2/3 ride toward target 2. Trail your stop 15 points below each successive 60-minute swing low. Don't trail too tight. Give the trade room to breathe within the daily trend. Strategy 3. Aggressive. The preemptive support fade. This is not for beginners. It's a high-risk, high-reward entry that requires discipline, speed, and the emotional capacity to take fast losses. Entry condition. If the S&P 500 gaps down into the 7,175 to 7,180 zone at the next session open, and the first 15-minute candle shows a bullish rejection, hammer or bullish engulfing, enter long on the close of that 15-minute candle. You're fading the gap. Betting institutional buyers have limit orders stacked at this level. Stop loss, 7,165, 10 to 15 points below entry, just beneath the structural swing low. Risk is narrow, max 15 points. Logic. If this level doesn't hold on the first test, institutions have pulled their bids, and a deeper drop to 7,140 is coming. Exit before that. Target 1, 7,200, psychological level and yesterday's close. 20 to 25 points gain, roughly 1.3-1.7:1 risk-reward. Target 2, 7,230, prior all-time high area. Achievable within the same session if the bounce is sharp. This strategy is for professional risk-takers only. The gap fade is one of the most statistically profitable patterns in equity index trading, but it fails violently when it fails. Historically, this setup has a 55 to 60% win rate, meaning 4 out of 10 trades will stop you out. You need the discipline to accept that and move on without revenge trading. Let's be clear about probabilities across all three strategies. The conservative setup works till the 70% of the time in a trending bull market. The standard breakout works till the 60-65% of the time but offers higher reward to risk. The aggressive fade works till the 55-60% of the time. This isn't about being right every time. It's about sizing positions so that even a 40% win rate produces positive expectancy over 50 to 100 trades. A trader who risks 1% per trade with 2.5:1 reward to risk at a 50% win rate will compound capital relentlessly. That's the math. Respect it. Most traders fixate on being right. Professional traders fixate on the expectancy equation. Be professional. 2.6 Risk management. Bell before you take any of these trades. Let me say something that could save your account. Never risk more than 1 to 2% of your total trading capital on a single position. For the aggressive strategy, cap it at 0.5%. The math is unforgiving. A 50% drawdown requires a 100% gain to break even. Position sizing is the only edge that survives every market regime. Don't hold positions into major news events unless you're explicitly trading the event with a defined risk budget. This week, watch for Middle East escalation, Fed speaker comments, especially Kashkari or Logan, and earnings surprises. Nvidia on May 20th is critical. If holding through it, widen your stop or reduce your position size. A stop loss is not a suggestion. It's a hard price where your thesis is proven wrong. If you override it, you're not a trader. You're a gambler hoping for a miracle. That path leads to zero. I've seen it happen to traders smarter than me. The survivors cut losses without hesitation. If you take 2 consecutive losing trades, stop, walk away. The market will be there tomorrow. Your capital might not be. Here's what you need to remember from today's session. The S&P 500 pulled back 29 points from a record high. This is a normal, healthy pullback in a structural bull market driven by 27% earnings growth and $18 billion in SPY inflows. The line separating bulls from bears is 7,175. Above it, we target 7,244, then 7,286, then 7,300. Below it, we shift to neutral and reassess. The Fed is turning hawkish, geopolitical risks are elevated, but earnings momentum is undeniable. This is not a market to bet against, it's a market to trade with discipline, to find risk, and patience. Tomorrow, keep your eyes on 7,175 at the open. Also watch oil prices. If crude spikes above $75 on Middle East escalation, that's the variable that could trigger a deeper pullback. And watch for Fed speakers softening their hawkish dissent. If they do, risk appetite will snap back instantly. Now I want to hear from you. Are you a buyer at 7,175, or do you think this pullback is the start of something bigger? Drop your line in the sand in the comments. Give me a number and tell me if you're long or short at today's close. I read every comment, and the best takes get pinned. If this breakdown helped you make sense of today's price action, hit the like button. It tells the algorithm to show this analysis to more serious traders. Subscribe and ring the notification bell for daily coverage across 8 assets: S&P 500, gold, crude oil, Bitcoin, Euro to US dollar, Pound sterling to US dollar, Australian dollar to US dollar, and US dollar to Japanese yen with Nike. Every trading day, rain or shine. I'll see you in the next one. Trade smart. Manage risk. Let the market come to you.